It's time for Money Tuesday, and if you have a 401k or let's say you're getting close to retirement, this is something you definitely need to pay attention to. We're talking about concentrated stocks. You might have heard of this, and talk more about this is Marshall Clay with the Welch Group, because sometimes that can be what is called a dangerous position to be in. Good to see you this morning.
Hey, good to see you.
And first of all, what are concentrated stocks?
So I guess the textbook definition is any one individual company that gets disproportionately large within your portfolio. So there's no black and white, there's no consensus on the exact percentage within the portfolio, but we use a 7% percentage. So it's really any company that gets disproportionately large that can disproportionately affect the movement within your portfolio.
All right, we got some images on the screen here about what you want to talk about: voluntarily, involuntarily, and employment executive compensation programs. Explain those three factors.
Yeah, so oftentimes these concentrated positions can be created voluntarily. And what I mean by that is people taking speculative bets. Like, I'm going to make a big bet on, let's say, Apple, for example. So they put a disproportionate amount of their money in one particular stock. So that would be an example of voluntarily. Involuntarily would be you start off in a small stock position, you have some success, and that position grows to a concentrated position just through success. And a lot of times I see this not necessarily through growth, but through executive compensation. So a lot of executives, a lot of employees are compensated through employer stock or company stock. And so what happens is they keep receiving that stock, and it just builds up to this really large percentage. And it's not necessarily a bad thing. I don't want everybody to run out and just start selling stock left and right. It's not necessarily a bad thing, but you just want to understand and appreciate the potential dangers, particularly as you get closer to retirement, as you get closer to actually needing money from the portfolio. Because if that one company, something goes wrong with it, something happens, and this happens all the time. If you look last year, for example, a lot of these supposed defense company or defense type stocks, Apple, things like that, dropped 30–40%. And they're the best companies in the world, so it can happen to any company.
So what kind of actions should somebody take to maybe protect themselves then?
Yeah, well, I think one thing, when you and I were talking about this off air, that it doesn't just pertain to individual companies. If you look at some of the mutual funds out there right now, if you look at some of those exchange traded funds that sort of present themselves as diversified investment products, they actually contain concentrated stock positions. So it doesn't mean that you want to necessarily sell out of that particular fund, but you may want to have some other funds mixed in there to offset those concentrated positions. So it's important to look at the individual funds within those 401ks as well. But I think that the first way to mitigate it is just maintaining a disciplined investment approach, maintaining a diversified portfolio at the outset, and having a disciplined approach to that rebalancing annually. And I tell people when they're doing the rebalancing, particularly if you're rebalancing a taxable account, don't let the tax tail wag the dog. Don't let that dominate, how you view your portfolio. Sometimes it's okay to pay tax. Now, you want to take some steps to try to offset those taxes. Obviously, you want to do tax loss harvesting. I know we've talked about that in the past, where you harvest some losses in other areas of your portfolio to counteract gains. But don't let the tax tail wag the dog. Go ahead. Sometimes it's okay to sell those or to actually appreciate or realize those taxes. And then there's some other more complicated steps where you're gifting appreciated stock positions. And so that's in conjunction with a charitable goal. So there's some other things that you can take, but just be aware of those dangerous concentrated positions and try to take some steps to mitigate that risk.
All right, we're going to wrap it there. Marshall Clay with the Welch Group, we do appreciate it. Thank you.
You're welcome.
All right, the buzz coming up.